In the last 24 hours, three things happened that most people will look at separately, but global investors are already connecting as one story. First, Treasury yields jumped again, pushing borrowing costs higher right when Washington needs to refinance trillions. Second, oil spiked on fresh geopolitical tension in the Middle East, and that matters because it keeps inflation pressure alive, even as growth slows. And third, the US debt number itself keeps climbing into territory that used to be unthinkable, now sitting in the high 30 trillions. At the exact moment, the market is less willing to fund deficits at cheap rates. Put those together and you get the real problem. The United States doesn't just have a big debt number. The United States has a funding model that depends on a constant flow of buyers, constant confidence, and constant stability in rates. And the global investor community, the people who actually have to absorb this paper, are starting to treat US debt as something you trade and hedge, not something you blindly hold. By the end of this video, you're going to understand why rising US debt is becoming a major concern for global investors, what the bond market is quietly signaling, why the reserve currency advantage is not a blank check, and what this setup implies for the dollar, for gold, for silver, and even for Bitcoin as a parallel hard asset trade. And here's the part most financial media still won't say out loud. The risk isn't that America defaults tomorrow. The risk is that the system starts charging a higher and higher price for financing America's promises, and that cost spreads through everything. So let's start with the simplest truth, because it's the one people keep dodging. Debt is not just a number. Debt is a payment schedule. When the US government borrows, it doesn't borrow forever at one fixed cost. It constantly rolls, refinances, and reissues. And that means the market is always involved. The market votes every single week. A lot of viewers hear national debt and think it's like a mortgage you slowly pay down. It's not. It's closer to a giant balance sheet that has to be refinanced over and over. Bills, notes, bonds, floating rate securities, inflation-linked securities, all of it. And the shift we're living through is this. For a decade plus, the US financed itself in a world of near zero rates and central bank liquidity. In that world, deficits didn't feel expensive. You could run trillion-dollar deficits and the interest cost didn't explode because rates were pinned, but that regime changed. Now you have a debt stock that is massive, and the average interest cost on new issuance is not near zero anymore. Even if the Fed cuts a bit here and there, we are not going back to 2020 rates. The market has a memory now. Inflation happened, supply shocks happened, geopolitics happened. And when investors lose confidence that inflation is permanently dead, they demand compensation. Let me translate that. The US is walking into a world where it has to refinance a mountain of debt at meaningfully higher rates than it was paying before. That alone should make you sit up, because global investors aren't staring at the debt number in isolation. They're staring at the trajectory of interest expense. And this is where the story goes from big debt to systemic concern. CBO, Congress's own budget referee, has put out projections showing deficits staying huge and interest costs rising hard in the years ahead. The key phrase here is net interest. That's the part of the budget that is purely the cost of the past. It's yesterday's promises charging rent on today's taxpayers. Here's why that matters. If interest costs rise toward $1 trillion a year and then keep climbing over the next decade in baseline projections, that means the government has to borrow just to pay the interest, unless it cuts spending or raises taxes dramatically. And that's before you even talk about recessions, wars, bailouts, or emergency spending. That's the everything stays normal scenario. Most people don't understand how destabilizing that is, because once interest becomes one of the biggest line items, competing with defense, with healthcare programs, with everything, your fiscal flexibility shrinks. And global investors know it. They see the math. They see the political incentives, they see the gridlock, and they price risk accordingly. Now, at this point, someone always says, yeah, but the US can always print. It can always pay. True. And that's exactly why global investors are concerned, because paying by printing is not a free solution. It's a transfer. If you can't close deficits through real fiscal discipline, meaning spending cuts or higher taxes, then the pressure shifts to the currency. Either you borrow more and hope the market funds it without demanding higher yields, or you lean on the central bank and liquidity tools, directly or indirectly, which over time erodes purchasing power. That is the definition of debasement, not a cartoonish overnight collapse, a slow erosion, especially versus hard assets. And that's why this is a macro story, not a politics story. Now let's add the second signal, because this is the one insiders track: demand at the margin. Who is buying US Treasuries, and how stable is that buyer base? A lot of people still talk like foreign buyers are a monolithic force that will always fund America because they have to. But when you look at the actual data, Treasury's own international capital reporting, you see something more nuanced. Foreign holdings are real, they are large, but they're not infinite. And the composition matters. You can see major holders like Japan, the UK, China, Canada, and a long list of financial centers that act as custodians for global pools of capital. The total number is massive, trillions. And yes, there are months where holdings rise and months where they fall. But here's the buried detail that matters. The debate is shifting from will foreigners dump treasuries to will foreigners keep increasing exposure at the same pace needed to fund ever larger deficits. That's a completely different question. A system doesn't break only when someone sells aggressively. Sometimes it breaks because the incremental buyer steps back. Because the marginal bid weakens, because auctions clear, but they clear at a higher yield, because the price of funding rises. That's why serious investors obsess over auction dynamics. Bid to cover ratios, the tail, who takes down supply, how much dealers have to warehouse. It's not because one auction decides the fate of the world, it's because auctions are the heartbeat of the funding machine. And when the heartbeat changes rhythm, you pay attention. Now, there's another layer to this that most media won't connect. Global investors aren't just looking at US debt, they're looking at alternative safe assets and alternative reserve dynamics. If you're a sovereign wealth fund, a central bank reserve manager, a global insurer, a pension fund, your job is to preserve capital over decades. You don't get to be emotional. You don't get to be ideological. You follow incentives and risk. And those incentives are shifting. Higher deficits plus political dysfunction plus repeated fiscal standoffs over the years have already pushed rating agencies to take action. We've seen major agencies strip the US of top-tier status over time. Whether you agree with ratings agencies or not, the point is, the downgrade cycle reflects a perception shift in the institutional world. And perception is a price. When a global investor looks at treasuries today, they see three overlapping risks. They see duration risk, rates can go up, and the bond price can fall. They see inflation risk, purchasing power can erode. And they see policy risk, fiscal decisions, debt ceiling theatrics, sudden issuance surges, unexpected regulation. If you're holding treasuries as the anchor of your portfolio, those risks matter. Now, let's tighten the loop back to the hook, because I told you 3 things happened in the last 24 hours, and most people aren't connecting them. We talked about yields jumping, we talked about debt and interest. Now let's talk about the geopolitical piece, because it's not just headline noise. It directly hits the funding story. When oil moves sharply higher because of Middle East risk, inflation expectations can creep back up, even if core inflation is easing. And when inflation expectations rise, long-term yields tend to rise, or at least they resist falling. That's critical because the US funding plan implicitly assumes that rates will come down enough to relieve pressure. If geopolitical risk keeps oil volatile and oil keeps inflation sticky, the rates will save us narrative gets weaker. Let me translate that. If inflation stays stubborn because energy and supply chains keep getting hit, then the market demands higher yields to lend long-term, and the debt service burden rises further, so the debt story isn't separate from geopolitics. Geopolitics can literally change the interest rate the US pays. Now, let's stack a third signal, and this one is quiet but powerful: the maturity wall. The US has issued a huge amount of short-duration debt over the years, bills that roll frequently. That's not necessarily bad in a vacuum, but it creates sensitivity to rate changes. When rates rise, the cost of refinancing rises faster. Think of it like this. If you have a 30-year fixed mortgage, rate changes don't hit you much. If you have a loan that resets every few months, rate changes hit you immediately. The US has a lot of debt that effectively resets. So when yields are above 4% on the 10-year and the front end is still elevated relative to the zero-rate era, the refinancing machine is not just expensive, it's volatile. It depends on weekly market conditions, and global investors know it. They see a government that must come to market constantly. They see a private sector that must absorb supply. They see a central bank trying to thread the needle between inflation and growth. And they ask, what happens if there's a shock? That's why this story is gaining urgency. Because the US doesn't have to collapse to create a problem for investors. It just needs to create enough uncertainty that the market demands a higher risk premium. And that's exactly what rising debt tends to do over time. Now, here comes the midpoint pattern interrupt. Because if you really want to understand why global investors are worried, you have to look at one statistic that reframes everything. In baseline projections, there are periods where mandatory spending and net interest together roughly match total revenues. Let that sink in. If your mandatory obligations plus interest essentially consume your revenue base, then everything else, defense, infrastructure, discretionary programs, emergency spending, gets financed by borrowing. Read that again. Borrowing doesn't finance some of the government. It becomes the financing mechanism for anything that isn't locked-in entitlement or debt service. That's the point where investors stop thinking in political slogans and start thinking in credit dynamics. Because when a borrower's fixed obligations consume most of their income, the system becomes fragile. Any shock forces hard choices. And the US faces additional demographic pressure as well. Aging population, healthcare costs, retirement programs. So the long-term trajectory matters. This is why global investors are not just looking at 2026, they're looking at 2030, 2035, 2040. And now you can see why debasement becomes a rational expectation, not a conspiracy theory. If the political system can't or won't close the gap, then the adjustment happens through inflation, currency weakness, or financial repression, keeping real rates below inflation so the debt burden is eroded over time. That's not speculation. That is how heavily indebted systems have historically managed burdens when outright austerity is politically impossible. Now let's pull in the fourth signal, because this is the one that shows up in portfolios: diversification away from pure dollar exposure. When global investors begin to worry about US debt dynamics, they don't necessarily dump the dollar overnight. They hedge, they diversify, they reduce concentration. They start doing something subtler. They buy more gold as a neutral reserve asset. They increase allocations to non-dollar assets. They raise exposure to real assets. And increasingly, in certain pockets of the institutional world, they consider Bitcoin as a kind of parallel hard asset with a different risk profile. You don't have to agree with Bitcoin to understand why that happens. The logic is simple. If the government's solution to debt involves persistent deficits and periodic liquidity interventions, Investors search for scarcity. Gold has the longest track record of monetary scarcity. Silver has the monetary history plus industrial demand, which can create its own squeeze dynamics. Bitcoin has algorithmic scarcity and portability, more volatile, yes, but also increasingly integrated into macro conversations. So when you see hard assets reacting to debt headlines and fiscal projections, it's not random. It's the market pricing the long term. Now, at this point, a skeptic might say, but everyone always predicts doom. The US has been in debt forever. Why is this different? Fair question. Here's what's different. The scale and the speed, combined with higher rates. When debt is small and rates are low, you can grow your way out, or at least manage it quietly. When debt is huge and rates are meaningfully higher, interest becomes a compounding problem. Each round of borrowing increases the base on which interest is calculated. And because deficits persist, you're adding to the base every year. So global investors aren't making a one-time judgment, they're updating a model. They're asking what is the steady-state outcome if deficits remain large and the interest cost remains elevated. And the answer is not comfortable. Either growth accelerates enough to shrink the debt burden relative to the economy, or fiscal policy tightens dramatically, or inflation runs above target for extended periods, or the central bank uses tools that effectively cap yields and inject liquidity when stress appears. Those are the routes. Which one is politically easiest? Historically, it's the one that doesn't require explicit votes: inflation and financial repression. That's why global investors are concerned, not because they expect a dramatic headline like default, but because they expect a slow, grinding erosion of purchasing power that changes the risk-return of holding long-duration dollar assets. Now let's get more specific about the bond market, because this is where the insider briefing angle comes in. The bond market is supposed to be boring. It's the plumbing. It's the foundation beneath everything. But when the bond market becomes volatile, everything else becomes unstable. Equity valuations change, mortgage rates change, corporate borrowing costs change, emerging markets wobble, banks reprice assets. And here's what's been happening. Yields have been stubborn. Even when inflation eases for a while, the long end doesn't always rally like it used to. That tells you the market is embedding a risk premium. Some of that risk premium is inflation uncertainty. Some of it is issuance supply, sheer volume coming to market. And some of it is fiscal credibility. This is why auctions matter. It's why who is buying matters. It's why central bank balance sheets matter. And it's why investors watch the Treasury's financing announcements and issuance schedules like hawks. Because if the market starts demanding more yield to absorb supply, the government's interest expense rises, deficits widen, issuance rises further, and you can get a feedback loop. This is where debt becomes not just a long-term problem, but a market problem. And global investors have seen this movie before in other countries. Not at US scale, not with reserve currency privileges, but the mechanism is the same. When supply overwhelms stable demand, price adjusts. In bonds, price adjustment means higher yields. Now add a fifth signal, and this one is psychological: narrative credibility. For years, the mainstream story has been that US Treasuries are the unquestioned global safe asset, and the dollar is the unquestioned reserve currency, so none of this matters. But the institutional world doesn't operate on faith. It operates on comparisons. If you can get similar yield in other markets with different fiscal trajectories, you consider it. If you can hold gold with no default risk and no political risk, you consider it. If you can shorten duration and reduce exposure to long-term fiscal uncertainty, you do it. That's why the concern is showing up not as one dramatic event, but as a slow shift in positioning. And here's the part many viewers in this community will appreciate, because you've been early before. The market often prices the trend long before the headlines catch up. When you see the conversation shifting from inflation is transitory to inflation could be stickier, and from deficits don't matter to interest costs are surging, and from foreigners must buy to foreign demand is variable, you are watching the story change. Now let's connect it to the dollar directly, because debasement without a dollar discussion is incomplete. The dollar can be strong in the short term, even in a debt-heavy system. In fact, during crises, the dollar often rallies because the world still uses it for funding and settlement. But over longer horizons, persistent deficits and rising debt tend to pressure a currency, especially if the central bank is expected to cut rates or intervene during stress. So global investors can hold two thoughts at once. They can believe the dollar remains dominant today and still believe the long-term value proposition is weakening. That's why the shift happens gradually. A reserve currency doesn't lose status in one day. It loses status in the margin over time through diversification. And diversification is already happening in the real world. Central bank gold buying, commodity trade settlement experimentation, regional currency arrangements, and a steady push by some nations to reduce exposure to U.S. financial sanctions risk. Even if those efforts are imperfect, the direction matters, because direction tells you where marginal flows might go. Now let's bring this home with a convergence moment, because at this point we've stacked multiple independent signals. And the power of this structure is that even if one signal is noisy, the others still point to the same conclusion. Signal 1, the debt stock is enormous and still rising, and deficits remain huge in baseline expectations. Signal 2, interest costs are rising because rates are higher than the zero-rate era and refinancing is constant. Signal 3, foreign demand exists but isn't infinite, and the market depends on marginal buyers absorbing relentless issuance. Signal 4, geopolitics can keep inflation sticky through energy prices and supply disruptions, which keeps yields higher and funding costs elevated. Signal 5, the bond market embeds a risk premium when fiscal credibility weakens, and that risk premium raises costs further. Signal 6, global investors respond by diversifying and hedging into gold, into real assets, and increasingly into alternative scarcity narratives. When you connect those dots, the picture becomes hard to ignore. Rising U.S. debt is becoming a major concern for global investors, not because they expect a Hollywood-style collapse, but because the funding model is becoming more expensive, more fragile, and more politically constrained. And that changes portfolio behavior. Now, what does this imply next? It implies we're likely to see more of the same pattern: bursts of volatility in yields, periodic stress in risk assets, and recurring episodes where the market forces policymakers to respond. Those responses can take different forms. Sometimes it's fiscal, temporary deals, spending shifts, tax adjustments. Sometimes it's monetary, rate cuts, liquidity facilities, balance sheet policy changes, or messaging designed to calm markets. Sometimes it's regulatory, nudging banks and institutions toward holding more treasuries through capital rules and liquidity requirements. And sometimes it's indirect, letting inflation run a little hotter than ideal so the debt burden shrinks in real terms. Global investors are watching which path gets chosen because each path has an asset market signature. If policymakers lean toward easier money and liquidity backstops, that's supportive for gold and other real assets over time. If policymakers lean toward fiscal tightening, that can slow growth and create recession risk, often bullish for high-quality bonds in the short term, but still complicated if issuance remains heavy. If geopolitics keeps oil volatile, inflation hedges stay relevant. If the market loses confidence in long-term fiscal management, the risk premium can become structural. This is why you'll see safe haven assets behave in ways that confuse people who only watch one chart at a time. Gold can rise even when yields are high if the market senses long-term debasement risk. Bitcoin can hold up even when risk assets wobble if the scarcity narrative gains traction. Silver can move violently when monetary fear intersects with industrial demand and thin liquidity. The key is the macro narrative. The key is connecting signals. And this is where you, watching this video, have an advantage, because most people are still being fed a simplified story. Rates go down, stocks go up, rates go up, stocks go down. Debt doesn't matter because reserve currency. That story is too simple for the world we're entering. We're entering a world where the cost of financing matters again, where geopolitics bleeds into inflation, where the buyer base for government debt is not automatic, where the bond market can become the center of gravity. And here's the final open-loop payoff, the thing I promised at the start about why these signals matter and what they imply next. The biggest risk is not that the US can't pay. The biggest risk is that the US can pay, but the way it pays changes the value of the currency over time. That's the concern global investors are waking up to. That's why they're watching debt, watching auctions, watching interest costs, watching geopolitical oil spikes, watching the Fed's balance sheet debate, and quietly building hedges. And when you see those hedges show up in the real world, central banks buying gold, investors preferring shorter duration exposure, institutions discussing alternative stores of value, you're seeing the market prepare for a new regime. A regime where the dollar is still dominant, but more contested at the margin. A regime where the bond market is still the foundation, but increasingly expensive to maintain. A regime where hard assets are not just speculative trades, but portfolio insurance. Now I want to ask you a direct question, because this community is ahead of the curve, and I want your read. Do you think the US resolves this through real fiscal tightening, actual spending restraint and/or higher taxes? Or do you think the system leans toward the path of least political resistance, more borrowing, periodic liquidity, and a slow erosion of purchasing power? Where do you think this goes next? Drop your view in the comments, because I read them, and the best discussions happen right there. And if you want more videos that connect the dots, debt, the bond market, gold and silver signals, central bank behavior, and the macro moves the mainstream still treats like separate headlines, make sure you're subscribed. This is why we cover these signals every day here on Safe Haven Metals. Because the real edge isn't having the loudest opinion. The real edge is seeing the pattern early, while everyone else is still arguing over yesterday's headline.